Is the stock caught in a falling trend, flashing massive sell signals? Or is it secretly a strong buy that the market is severely undervaluing?
Well, that is definitely the billion-dollar question right now.
Right, okay, so imagine opening the hottest, most exclusive restaurant in the city. The line is wrapped around the block, reservations are booked out for a year.
You are pulling in millions of dollars a night at the front door.
Exactly. But there is a massive problem hidden in the kitchen. The cost of the premium ingredients you are serving has just skyrocketed.
Oh, I see where you're going with this.
Yeah, so to keep up with the overwhelming demand, you are buying so much supply that despite making millions at the front door, your bank account at the end of the month is actually overdrawn.
Right. I mean, you were incredibly popular, but you were bleeding cash.
Yes. That tension, that feeling of watching a booming business that might just collapse under its own weight, is exactly what we are dissecting today as we dive into Supermicro Inc.
Universally known by its ticker SMCI. And the financials under the hood right now are creating, well, one of the most polarizing environments on Wall Street.
We have to set the exact scene for you, though, because context is everything when dealing with a stock this volatile. So today is April 22, 2026.
And as of right now, SMCI is trading at $28.43.
Right. It is down about 1.32% for the day. But the recent whiplash is what is driving traders crazy. I mean, it just pulled off a staggering 38% rally over the last 30 days.
Bouncing off a pretty bleak March low of just $19.50.
Yeah, yet if you zoom out and look at the broader landscape, it remains trapped in a brutal long-term downtrend from the highs we saw back in 2025.
Which brings us to the core mission for today's deep dive. We are looking at a deeply divided market, and our goal is to dissect the facts.
We are talking the hard financials, technical charts, and the underlying order flow.
Exactly. Through a natural human debate. We want to map out the terrain for you. But keep in mind, this is an analysis of market mechanics.
Right, this is definitely not financial advice.
We are just here to show you the mechanisms driving both the bull and the bear cases.
Okay, let's unpack this. Before we can even touch the debate of whether this stock is a hidden gem or a dangerous value trap, we need to look at the actual financial engine.
Because the fiscal Q2 2026 income statement is telling two violently opposing stories. First, the top-line numbers.
They represent a massive revenue explosion. I mean, Q2 revenue came in at $12.7 billion.
That is a 123% increase year over year.
Insane. And fiscal year 2025 annual revenue was $21.97 billion. But management just raised their fiscal 2026 guidance to a minimum of $40 billion.
A company doubling its revenue to hit a $40 billion run rate usually commands a massive premium, but, the breakdown happens when you move from that top-line revenue down to the gross margins.
Right, because a gross margin measures how much money a company actually keeps from a sale after subtracting the direct costs.
And SMCI's gross margins have collapsed to 6.3%.
So it sounds like they are selling a $100 bill for $94. Sure, your revenue will skyrocket, but your pockets are emptying.
That is a very accurate way to put it. They are bringing in over $12 billion in a single quarter, but only keeping about 6 cents on every dollar before operating expenses.
Wow. And that 6.3% is down from 9.5% just in the first quarter of this year, right?
Yes. And historically, this company operates around a 14.1% margin. So the profitability per unit sold is just evaporating.
I see. They posted a net income for Q2 of $401 million.
Which sounds substantial until you factor in that it took $12.7 billion in sales just to generate that $401 million.
You can really see the severe strain of this on their balance sheet. Like, their total assets are massive, sitting at $28 billion.
Measured against $4.78 billion in total debt.
But the operating cash flow is the statistic that really stops you in your tracks. It is currently negative $24 million for the quarter.
Yeah, and back in 2025, they had positive $1.66 billion in operating cash flow.
So why is a company with an endless line of customers banging down its door ending up burning cash? Like, what is actually happening there?
Well, the cash burn is a deliberate, albeit painful, strategy. It is tied directly to physical infrastructure. SMCI is essentially fronting the capital required to build the hardware for the global AI boom.
Right. They're running a negative cash flow because they are buying massive amounts of inventory.
Exactly. They are sitting on over $13 billion in backlog orders for Nvidia's new Blackwell Ultra GPUs.
So the demand is definitely real. The components are just so astronomically expensive to procure that SMCI is draining its own accounts to build the servers before they get paid.
Procuring those advanced components, assembling the architecture, and integrating complex liquid cooling systems requires enormous upfront capital.
Yeah, you have to physically deliver them to the data centers.
Right, so management has made a conscious choice to prioritize market share. They are fulfilling this historic surge in demand by sacrificing current profitability.
Betting that if they secure the physical footprint in the data centers now, the margins will stabilize and recover later.
Precisely. And that brutal margin compression is why Wall Street is fundamentally split on how to price this company.
Which leads us to the ultimate debate. Is SMCI deeply undervalued, or is it a classic value trap? Let's analyze the undervalued argument first.
Well, the stock's price to earnings ratio, the PE, is sitting at just 21.1x right now.
Finding a tech company growing top-line revenue by over 100% trading at a 21 multiple is incredibly rare.
It really is. Fair value estimates based on their cash flow suggest that if those margins can stabilize, the intrinsic value of the stock actually sits near $74.53.
Okay, so the bullish thesis relies entirely on that stabilization.
Yes, but the bear camp argues that SMCI does not deserve a tech premium at all. They argue the company has devolved into a mere box mover.
A box mover. So the narrative is that SMCI is simply taking highly valuable Nvidia chips, placing them into generic metal chassis, and shipping them out.
Exactly. And if a company is just moving boxes, they are dealing in commoditized, low-margin hardware with no competitive moat.
Under that framework, bears argue it should be valued much closer to legacy hardware companies like Dell or Hewlett-Packard Enterprise.
Right, and those traditionally trade at much lower multiples.
Here's where it gets really interesting, though. I have to push back on the idea that they're just snapping together low-margin metal boxes.
Go ahead.
I mean, AI infrastructure makes up over 90% of SMCI's entire business now. They recently rolled out their Gold Series enterprise servers.
And the highly specialized edge AI systems with AMD EPYC processors.
Exactly. And more importantly, they are pioneers in liquid cooling technology. These new AI chips run incredibly hot. Air cooling just does not work anymore.
You really need complex plumbing running through the servers to keep them from melting down.
Right, so are they really just snapping together low-margin Legos? Or is the market ignoring their specialized tech?
Well, hardware engineering, no matter how advanced, historically faces rapid commoditization. I mean, Dell and Lenovo are not just sitting still.
True, they are pouring billions into their own liquid cooling solutions.
And Wall Street is terrified that SMCI had to slash its prices to win that $13 billion backlog. If they give up their pricing power just to beat Dell to the punch, well,
that 6.3% margin might not be a temporary glitch.
it might be the new normal required to maintain their market share. Plus, the valuation is being heavily suppressed by external risk factors.
Like the ongoing regulatory and reporting scrutiny.
Right. Institutional money hates uncertainty more than a bad earnings report.
Any hint of reporting irregularities keeps the massive pension funds and mutual funds from touching the stock. It is like a ticking time bomb.
And that creates an artificial ceiling on the price. But the structural risk is what truly limits the multiple. A single customer represents an astonishing 63% of SMCI's total revenue.
Wait, really? 63% of their money comes from one single client.
Yes. Obviously, we are talking about a massive hyperscaler here.
But why would a giant tech company allow SMCI to control that much of their critical infrastructure deployment? Why wouldn't the customer spread the contracts around to avoid a bottleneck?
It really highlights a precarious codependency. SMCI built the specialized manufacturing capacity and liquid cooling architecture faster than anyone else.
So the client became heavily reliant on them to meet their own aggressive data center rollout schedules.
Exactly. But it leaves SMCI in an incredibly vulnerable position. I mean, does 100% year-over-year revenue growth matter if your survival depends on one entity?
Yeah, if that customer decides to bring the assembly in-house or leverage their size to force even lower prices, SMCI loses more than half its business instantly.
With fundamental analysts completely polarized between a $74 intrinsic value and a box mover doom scenario, this conflict is bleeding directly into the stock's daily price action.
You can literally see the tug-of-war on the charts.
The 52-week range is incredibly broad and illustrates the volatility of that battlefield perfectly. The stock has swung from a high of $62.36 down to that recent $19.48 low.
And when assessing the current momentum, the relative strength index, the RSI, is hovering around 58.
Which is generally considered neutral bullish.
Right, for you listening, the scale goes from 0 to 100. So 58 indicates the stock's momentum is building upwards, but it hasn't reached the 70 level where traders consider it overheated or overbought.
And the short-term moving averages reflect that building momentum as well. SMCI is trading above both its 20-day and 50-day simple moving averages.
That suggests a short-term trend reversal is attempting to take hold after the long, agonizing march downward.
But the price is sandwiched in a highly restricted corridor defined by major support and resistance levels. Immediate resistance is sitting at $29.
That is the ceiling traders are struggling to punch through right now.
If it clears that, the next hurdle is an analyst target sitting at $33.20, followed closely by major psychological resistance at $35.
And on the downside, support is currently holding at a recent test of $26.50. If the stock falls through that, there is very little catching it before it plummets back toward the 52-week low of $19.48.
The order flow data reveals the psychology of the major players right now, tracking where the massive institutional block trades are being positioned.
And currently, institutional buy interest is very high, right?
It is, but those buyers are refusing to chase the price upward. They have parked their buy limit orders down in the $25 to $26 range.
So they're just waiting patiently for the price to drop to them.
Exactly. And conversely, there are massive sell walls stacked at $30 and $33, ready to absorb any buying pressure.
So if I am looking at $28.43 today, and the institutions are sitting down at $25, waiting with a catcher's mitt.
While highly motivated sellers have built a brick wall at $30.
Right. Where is the upward momentum supposed to come from if the big money refuses to participate at the current price?
Well, it creates a perilous environment. This specific setup establishes a tight trend direction, basically bullish neutral, where institutions often set traps for retail volume.
So the big money will just let the retail volume bounce the price back and forth between 26 and 30.
Yeah, collecting premiums while waiting for a definitive fundamental catalyst to dictate the real breakout or breakdown.
That lack of institutional upside momentum brings us to the most immediate danger for you listening. There is a brewing storm of short-term volatility fueled by retail FOMO ahead of earnings.
Analyst signals really reflect the broader hesitation. Consensus is currently hold or moderately buy.
JP Morgan actually recently lowered their target from 40 down to 28, which is exactly where the stock is trading right now.
And the average one-year target across the street is $33.20. But retail traders aren't looking to hold a volatile stock for a year just to make a few dollars per share.
No, they're looking at the setup heading into the upcoming earnings on May 5, 2026, and it is highly explosive.
Short interest is high, sitting at roughly 16.16% of the overall float.
Meaning over 16% of the available shares have been borrowed and sold by traders betting the company will fail.
But on the derivative side, we are seeing a massive 67% increase in call open interest for the April 24 expiry.
So what does this all mean?
This is the anatomy of a potential retail trap. The retail traders see that 16.16% short interest, and they are actively trying to trigger a short squeeze.
By aggressively buying short-dated call options, hoping for a moonshot before the earnings report.
Exactly. When a retail trader buys a call option, the market maker takes on immense risk. To protect themselves, they are forced to go into the open market and buy actual shares of SMCI to hedge their position.
And that forced buying by the market makers artificially drives the stock price up.
Right. Then when the price rises, the short sellers start taking massive losses, panic sets in, and they are forced to buy shares themselves just to close their losing positions.
You get a violent feedback loop. Retail buys options, market makers buy shares, price spikes, short sellers buy shares to cover.
It forces the stock price into the stratosphere.
So retail traders are buying options, hoping for that moonshot, while the charts show a falling channel and big money is sitting on the sidelines. Is this the classic definition of a retail trap?
I would definitely agree it is. The downside risks of trying to force that squeeze are immense. If the stock loses that fragile $27 support level, the sellers will overwhelm the buyers.
The falling channel resumes, and we could see a rapid, unceremonious drop right back down to the $20 level.
And if that happens, every single one of those short-dated retail call options expires completely worthless, wiping out the retail traders in an instant.
It is a high-stakes game of chicken. There is, however, one weakness signal providing a sliver of underlying stability amid the chaos.
You mean the insider holding?
Yes, the people running the company aren't panicking. There has been no major insider selling reported in the last 30 days. CEO Charles Liang remains a significant holder of the stock.
When executive leadership holds their equity through severe margin compression and a brutal 50% drop from previous highs, it signals a deep conviction in their own long-term thesis.
They genuinely believe the $40 billion revenue guidance will ultimately vindicate the current cash burn.
We need to pull all of these conflicting signals together and outline the bull versus bear outlook for SMCI.
Right. In the short term, like over the next few weeks heading into the May 5 earnings report, you have to expect extreme volatility.
Market sentiment is leaning slightly bullish, with options traders aggressively eyeing that $33 to $35 resistance level.
But it is an absolute tightrope walk over a canyon.
Looking at the long-term perspective, the best-case recovery scenario relies entirely on margin recovery.
If SMCI can leverage its scale in liquid cooling and high-performance server architecture to push those gross margins from 6.3% back toward a healthy 10%.
Right. Yes, if they do that, the stock could see a massive re-rating from the major institutions.
But getting back to 10% is going to be a brutal fight. If competitors are actively undercutting them to win data center contracts, those margins might stay depressed.
And if the box mover narrative becomes reality, the worst-case scenario unfolds. A continuation lower. The stock breaks support, crashes through $20.
And if that lingering regulatory scrutiny boils over into actual penalties, the bottom could fall out completely.
The line between a visionary market leader and a value trap rests entirely on whether their aggressive capital deployment translates into sustainable pricing power.
It all comes back to that initial tension. The revenue is exploding past $12 billion a quarter. The demand is historic.
But they are burning through their cash to keep the engine running.
And as we wrap up today's deep dive, there is one lingering provocative thought for you to mull over.
It is about that concentration risk, isn't it?
Exactly. We know that 63% of their entire revenue comes from just one single customer.
Which is a staggering vulnerability.
So you have to ask yourself, if 63% of your entire revenue comes from just one single customer, are you truly an independent market leader riding the wave of the AI revolution?
Or are you just a highly paid employee of that customer waiting for the day they decide they can do your job cheaper themselves?
That concentration risk is the ultimate shadow hanging over the balance sheet, and it is the question every investor has to answer before stepping onto this battlefield.
It really is.
We want to know what you think. Like this video, subscribe to our YouTube channel, and it is absolutely compulsory that you leave your comments and feedback below. Tell us, is SMCI a value or a trap?